Hello, everyone. It's PJ Patterson here for a market update for the 2nd of March, Monday, the 2nd of March. Really interesting things happening. I'm sure you'll agree with me that last week was a crazy week in global markets. I'm going to discuss all of that today. Top three things are first and foremost coronavirus, and I'm going to have a bit of a discussion on that. Secondly, crash or crashing. Are the markets crashing as we speak? And finally, where I think we're going to from here. I'm going to show you some charts and a couple of other data points and talk to you about risk managing this and how I'm risk managing this situation. So let's start off with the coronavirus. First of all, this coronavirus thing, I've got a couple of, opinions or ideas on what's going on with the coronavirus. The first thing that is interesting about this coronavirus is that it is not much worse than the flu in the sense of the symptoms and who it affects and who has the greatest risk factor of dying from it. And to put this into perspective, and this is always what we have to do with stuff like this, to put this into perspective, I want you to think about this. Globally, there are approximately 300,000 to 600,000 deaths per year from the flu virus. That is a lot of people dying from the flu virus globally, mind you, globally. And we've had, I think, up to this point, something like a few hundred deaths from the coronavirus, maybe 1,500, I don't know exactly, but it's not very many in reality. Not a lot of people are infected. I think it could be around the 50 or 60,000 being reported. And so really this whole coronavirus thing pales in comparison to stuff that happens every single year, and yet we don't get up in arms about it. Markets don't crash because of the flu season every year. It's really interesting. I was going to use a different word, but I've chosen carefully. It's very interesting what's going on. Now, this is what I want you to probably think about, right? First of all, two things. We were headed this direction anyway, globally, with the economic situation. The central bank's policy is not set correctly. Data, as I continue to highlight for you, data is continuing to slow and show that China's in a bad way. Asia in general is in a bad way. The U.S. not doing great. So globally, we already had a situation we were headed down this path. Now, the coronavirus thing seems to have exacerbated this, and the media has seized on it and made this a really big issue when it actually isn't. They're trying to scare you into thinking that there's, a pandemic on our hands. But this is just ridiculous. Healthy people recover from this virus. Healthy people generally aren't affected by, as you could imagine, the flu or any of these other diseases that float around the world. And probably to put this really even into further perspective, is more people die every year from opioid overdose. So this is actually prescription opioids, so all those painkillers and things like that people get addicted to. More people have died from that every year than have died from corona. More people die of hunger every year than die from the flu or even the coronavirus combined. So, ladies and gentlemen, this is all blown way, way out of proportion. And I think the markets have just seized on it because it's that catalyst, it's that final snowflake that lands on the avalanche, lands on the snow pile to cause the avalanche. So my view is that this is is getting hyped. It's getting blown out of proportion. People are in panic mode because of it, and that's what you're seeing with this market reaction. I'm going to get more into some market detail in a second, but I just thought I'd put that in perspective. The second thing that I want you to probably think about with this and watch closely is how quickly they come out with another vaccine that we need to take because of the coronavirus. This, I think, ladies and gentlemen, is an opportunity for the big pharma industry to, again, make windfall profits from rolling out a vaccine for something that actually isn't that big of a deal. And The interesting thing about vaccines, ladies and gentlemen, is that they do not require the rigorous testing that a drug does, at least in the U.S., I believe worldwide, that is required to roll out a new drug. So there's not going to be any trials or any of this sort of thing for this vaccine. They're just going to roll that out. And don't be surprised if we see a resurgence of the coronavirus in a couple of years, if they do end up doing this vaccine thing, because the vaccine won't work. Vaccines, look, I'm not going to get into a debate around vaccines, but I have a big question mark over a lot of vaccines to begin with. And I think this is just a stitch up. So form your own opinion on that, but certainly Google all the things I've said. You're going to find some pretty shocking statistics about other things that cause a lot of deaths every year. More people die from dysentery and diarrhea and poor water quality. And yet we're not throwing billions of dollars and shutting down the world economy and trying to solve that problem. It's just ridiculous. It's hypocritical. Anyway, let's move on. So what does this mean? What does the action of the last week actually mean for us as investors? Well, I'm going to show you a couple of things here if I can jump up on my screen. So first of all, again, the bond market is telling us what's going to happen with interest rates in the U.S. Do not be surprised if this month and even this week, so we have an RBA meeting tomorrow, I believe. I would not be surprised at all if we see the Reserve Bank of Australia cutting interest rates, citing the coronavirus and what it's going to do, because our economy is not doing great, and this is really going to cause some serious problems for us. But we were headed there anyway, but this is going to be that tipping point. The U.S. Treasury market chart, which you see on your screen right now, look at that thing. It just fell off a cliff. So this is the interest rate. This is the 10-year yield. And remember, when yields fall, bond prices rise. So I'm very happy that I have had bond positions on for clients because they've made money in that position. So anyway, this will be probably getting towards the bottom end of its range and looking to bottom out at some point very soon. So I'll probably dial down some of that exposure. But in any case, this chart is telling you everything you need to know about where interest rate policy is going in the United States and most likely in Australia and other parts of the world as well. The other couple of charts I thought I'd show, actually I'll come back to that in a second. Let me show you just what the Aussie dollar is doing. Now, my little blob has gone away, but this is a chart of the Aussie dollar. And what you can see here is back in sort of December, Jan, we were trading right around that 70-cent mark. Things were looking okay. We were headed higher. We had a bit of a low around the 67-cent mark, and then it was moving up nicely, firming up, looking like things were, we were going into quad 2 perhaps in Australia, or even quad 1. But really the globe was kind of positioning for quad 2. But as I had warned you and been telling you during that time frame, that was not going to eventuate. Well, anyway, long story short, if you just look at this chart, for the better part of the last 3 months, the Aussie dollar has been on a very steep downward trajectory. And as you can see here, we had a massive trading range on Friday, but the Aussie is sitting somewhere around the 64-cent mark as we speak. Sorry, just below the 65-cent mark, 64.85 or so cents. And this is pretty bad. And again, I think the currency is telling us a story here. The currency gets it, right? So the thing about watching a lot of these big markets, and remember, the bond market and the currency markets are arguably two of the largest, most liquid markets in the world. Trillions of dollars of currencies trade every day, and hundreds and hundreds and hundreds of billions of dollars of debt trades every day. So what I think that chart is saying is the RBA is going to cut rates on Tuesday because it has gotten caned. So we'll see what happens. I mean, we don't know until they make the announcement, but markets aren't stupid. Markets are very smart, and if you just watch them closely, as I do, they tell you a lot of information. So moving on from sort of the coronavirus discussion into, are we in a market crash at this point in time? That is a very interesting question. Now, I think the Dow and the S&P are down about 12% since the beginning of last week and late the following week as this whole coronavirus thing started to take on a life of its own. Now, one thing I want to say about crashes and what the structure of the current market is that 90% plus of daily trading is done by machines. Now, when I say it's done by machines, literally I mean it's called high frequency trading. Look it up, HFT, high frequency trading. And a lot of these big hedge funds and huge investment houses like Morgan Stanley, JP Morgan, HSBC, all these guys, they have invested hundreds of millions of dollars, I would say, in basically computer programs, algorithms that trade the market. And they do this stuff in nanoseconds. And so most of the volume on markets now and most of the trading activity is a machine. And so machines have rules, and a lot of what machines do is trade headlines. Now, that happens on a day-to-day basis. But where we get into a crash or a situation where one that we've seen, like we've seen in the last week, is where the actual market participants are positioned in the wrong way. And just see if I've got this chart on positioning. Here we go. So not chart, but rather this is a commodities futures trading, commodity futures exchange trading details for futures contracts on the market. Let's see if I can just make this a little bit bigger. But in any case, what I want to show you here is this is effectively telling you how non-commercial, so these are sort of hedge funds and people like me, and not that I trade futures, but your everyday sort of Joe Blogs people, how they're positioned in the market. And this is really fascinating. For the most part, the hedge fund community was short debt, so this is what this negative amount is. They were short futures contracts on all of the interest rates, 2, 5, and 10-year. Short on the Treasury bond. They were slightly long dollars, not really long dollars here. That's not a massive sort of long contract position. But they were long. They were short volatility as well. This is what this VIX is all about, short volatility. They were net long things like the Dow, the Russell, the NASDAQ, the S&P 500. So in other words, Wall Street was positioned in the wrong way. And so when you are, as a money manager, positioned the wrong way, and you get this sort of cascading now crash that's happening, or real market volatility that's happening, you have to make some decisions very quickly. And there's going to be a lot of hedge funds, I suspect, not that we'll hear about it in the media per se, but there's going to be a lot of hedge funds in the last few trading days, even the last 7 to 10 trading days, that are probably going to go broke because they were on the wrong side of the market. So this is very fascinating. Again, it's all about data and what's going on. But the key thing that I want to key in on here is volatility. You hear me talk about volatility a lot. And the one lesson I want to give you about crashes is once volatility spikes above 15. So the normal vol for the market, the happy place, let's say, is that 15 volatility mark. And once it goes above 15, it's a little bit of a red flag. It's not, panic stations or anything like that, but it's sort of we got to watch and see what this market is doing. But once it actually spikes and goes above 31, that's when the poo is literally hitting the fan. And right now we're sitting, at least at close, I should say, with a 40 handle on it. So market volatility is extreme at the moment. And the lesson, ladies and gentlemen, I want to give you on market volatility is that volatility, it clusters and it's episodic. What that means, and you can look at this chart, and I'll put this on a 5-year time frame just to give you a bit more perspective. As you can see, volatility kind of goes along and it goes up and down a little bit. It's, nicely in a range. I don't know what the average on this is, but if you look, there's the 15 level, and it's, most of the time it's below 15. Some of the time it spikes above it, but, that's here nor there. We do get, though, these big spikes where it clusters. It goes bang. Something happens and volatility spikes. Everybody sort of panics and, traders are wrongly positioned or whatever. And you can see these spike areas. They don't happen very often. But when they do, it clusters and it spikes. And we've really had that situation here. So to go from 15 or thereabouts to 40 in a matter of a few trading days, that is a market crash effectively that's unfolding. So I'm keeping my eye clearly on volatility. And the one thing I want to say about that, I guess I'll transition into where we go from here. The one thing I want to say about volatility is now that it's spiked and it's at this level, I'm sitting on my hands. There's absolutely nothing that I am doing with client portfolios. What will probably unfold over the next few weeks, and you'll notice this from some of these headlines, and I'll just jump back to the CNBC headline. Now all of a sudden we've got people coming out saying, "Oh, we need to calm down." You've got the World Health Organization chief medical officer, or whatever, saying, "Hey, markets are overreacting." I think Pence was out saying something about it over the weekend, saying that the market will recover. Whatever. Trump is obviously very unhappy because he's watched $4 or $5 trillion of market capitalization evaporate in the course of a week. And so clearly, we now have the flip side of the machine saying, everything's okay, blah, blah, blah. So, and I think we even have the Fed making some comments over the weekend. I don't see that article anymore on here, but even the Fed, Jerome Powell, is coming out, and is saying, trying to make commentary to soothe the market. So where do we go from here? Well, first of all, I think you're going to see an interest rate cut this month from both the RBA as well as the U.S. Federal Reserve. Whether it happens or not, I do not know, but the bond market is giving you a strong indication that that is what is going to occur. We will see a rate cut. What will the rate cut be? Don't know, but we will see a rate cut. That should start to elevate and bring some life back into the equity market. The equity market will at some point bounce anyway, because as soon as the Fed turns on the monetary tap, traders and other people will get some comfort around that. They'll provide I was going to say they're going to provide liquidity, but there's already a lot of liquidity in the market, and that's obvious from the fact that we've had such high trading volumes, unbelievably high trading volumes over the course of the last probably 5 trading days. It just keeps getting worse and worse. But the question that may be on some of your minds is, how do I risk manage this? Well, first of all, I risk manage all of this by holding some of the right stuff. So, for example, own gold, own treasuries and debt instruments. I do have quad 4 positioning on for most portfolios, but the issue in the last few trading days is that we're now at an extreme because we've popped above that 31 on the VIX index, and because of that, pretty much everything gets caned. And mostly equities are going to do poor. So the gold mining equities, consumer staples equities, even the S&P low vol and S&P high dividend stuff that is a good quad 4 positioning asset is going to get hit a little bit. But it doesn't concern me at all, because the market's down about 12 to 15%, and over the last week, the overall decline that I've seen across all portfolios is about 1%, a little bit over 1%. So it's honestly, I have completely managed around this. And again, I think that once we see the Fed come to the rescue, the Dow and the S&P and the NASDAQ and some of these positions are going to recover or start recovering. And we might see a day, for example, you could easily see a day in the U.S. where everybody gets excited again and they start putting positions back on, and we see a 4 to 5% pop in the stock market. It's not unheard of for those sorts of things to occur, but I think likely what we'll see are some days where we see a 2 and 3% gain, and another day of 2 and 3% gain, that sort of thing, sort of building on itself, and it will the momentum will shift and it'll build its way back up. Look, I'm just going to have to wait and see what unfolds this week. But the key thing I want you to take away is we're still positioned for quad 4. That's where we're headed, or that's where we're at right now. Those positions are on, and I'm just going to sit tight. I don't want anybody stressing, panicking, feeling like there's any reason to be nervous, because in large part, everything is working as it should. And so with that, I think I will wrap it up. If there are any questions about individual portfolios, you want to jump on a call with me and have a quick look at your individual stuff, please let me know. And I will have an announcement probably next week. I'm going to begin rolling out finally our overall global wealth login and portal, where you're going to be able to get a snapshot of everything that's going on in your portfolio. So finally gotten that organized, and we'll be rolling that out slowly because I want to make sure there's no bugs in it, but slowly to clients. So have a great week. Don't stress, don't panic, and stay healthy. That's probably the best thing you can do to combat any coronavirus concerns. And I will come back with an update later this week if there's any reason to, and you'll probably see me either on Friday or Monday of next week. So have a good week. Talk to you soon.